So today's class will be recorded, and I will post this on to YouTube so you can follow what we do step by step as we go through the process. But again, we're going to, today in class, in this webinar, show you how to take the data that was previously exported from Bloomberg. And again, I posted to YouTube under the pages section. You can find it, February 19th link and Canvas, the video, which shows you step by step how to get data from Bloomberg using the Coca-Cola example that we're going to go over in class today. So it gets the screenshots. It shows you how to get and download the income statement, balance sheet, and cash flow data into Excel format. I apologize that I'm not able to do that live on the webinar, but the internet connection I have here is very restricted because of where I am, and so I can't get to Bloomberg. I actually had to use my cell phone to log on to Bloomberg and get the data, so couldn't do that for our webinar. In this case, I recorded the video, I posted it on YouTube, shows you step by step how to get the data. The 6 files that were outputted from that video, which you'll need to watch, are in the files section of Canvas right now. So if I click on files, I created a folder called KO for Coca-Cola, and these were the 6 files. This is the balance sheet, this is the cash flow, this is the DES screen, the description, which has the shares outstanding. This is the EEO, the earnings estimate for Coke. This is the income statement data, and this is the WACC, which will have the cost of capital that we'll use to discount. So for the in-class example, which we'll start in just a few minutes after we go over the midterm questions, these will be the files that we'll use. The other thing that we're going to use is from Starbucks, the valuation model. So I had put in an as-is and a final model to Starbucks. We're going to start with the as-is model for Starbucks as our starting file for the Coca-Cola valuation. So I'm just suggesting that take a couple minutes, and if you want to follow along with the process that we do in class, if you get the Starbucks valuation model, the as is, and you take these 6 files, put them into a folder, that is what we are going to be using. So while you're doing that, I'm going to talk a few minutes about the midterm exam. So if I go back to assignments, and if I go to the midterm exam, just want to go through the questions, the answers, and I will post a solution a little bit later this afternoon for the math part of the midterm exam. But most of you, from what I can tell in reviewing, did exceptionally well on the math conversion part of the midterm exam. What I'm going to focus on right now is some of these multiple choice questions. So I'm going to start with question 21. So assuming a company has a negative spread, positive growth rate that are both expected to continue, what would be the impact of an increase in the payout rate? This is really a question about the key value drivers equation. So one of the things that we know, there's a relationship between the payout rate and the investment rate in the firm. So 1 minus the payout rate equals the investment rate, which means that if we increase the payout rate, we would decrease the investment rate of the firm. So if we decrease the investment rate, then what would happen is growth is ROIC times investment rate. If we had less investment times the same ROIC, we would grow at a lower rate. So what would end up happening in this case is, assuming we still had a positive growth rate that is expected to continue, and in this case, if the growth was continuing, then what would happen is that we would actually get less investment going into the firm at a negative spread, and that would increase relatively the value of the firm. Right? So that's really what we're looking for here in question 21. So by not reinvesting the cash, we're paying it out, We're forcing ourselves to grow at a slower rate. And by growing at a slower rate, then what that means is that we are going to destroy value at a lower rate, thereby increasing the operating value of the firm. That was question 21. Question 22, EIC. Applying the EIC framework, which of the following should help the spread of an industry? Well, if we increase the rivalry, it's probably going to hurt the industry profitability and hurt the industry spread. If there's more buyer power, that's going to hurt the industry profitability and the industry spread. If we increase the power of suppliers, same thing. And if there's more substitutes, it'll be harder to make money. So all four of those would ultimately hurt the spread of an industry. So the correct answer in this case would be none of the above. For question 23, which of the following would increase the free cash flow of a firm? Remember that free cash flow is gross cash flow minus gross investment. So in this case, if we increase the operating cash required to operate the business, then we're increasing working capital, which means we're increasing investment, which means we're decreasing free cash flow. Not a correct answer. If we increase equity investments is non-operating and has no impact whatsoever on free cash flow. So that one doesn't apply. If we change the excess cash balance of the firm, that is non-operating, has no impact on the free cash flow of the firm. So the final one, and so really it just becomes, you can eliminate the middle two very easily, is the final one correct? A decrease in accounts payable means we're paying our customers faster, which means we are using less liabilities on our working capital. So current assets minus current liabilities. We have less current liabilities relative to our current assets. We have more working capital. More working capital equals more investment equals less free cash flow. So the correct answer for 23 by process of elimination would be none of the above. For question 24, which of the following statements is not true about a firm that holds no excess cash reserves with the following economic statement data? Positive no plat of 300, positive free cash flow of 200, CFI cash flow available to investors negative 100. They increased their interest-bearing debt by 150 and they paid dividends of 50. So in terms of non-operating cash flows must be negative. We know that that has to be a true statement because the only way you get from free cash flow to CFI is with the non-operating cash flows. So to get to a positive 200 to a negative 100, then the non-operating cash flows had to be a negative number, right? So that one is true. I'm looking for what's not true. Second, the firm had to borrow money to pay its dividends. Well, this firm clearly had negative CFI. So in this case, with negative CFI, the company had to borrow money in order to pay its dividends. They didn't have the cash to pay the dividends. So in this case, that would also be a true statement. Question part 3. The firm did not generate sufficient cash from operations to cover gross investment during the current year. Well, by definition, free cash flow is gross cash flow, no plat plus depreciation, minus gross investment. Well, in this case, with the positive no plat and free cash flow of 200, that means we had to invest at least 100. And we had enough profit to cover the investment and still have a positive free cash flow. Since positive free cash flow, we could cover our gross investment. So that one is the one that is not true. The firm indeed did have enough cash to cover its gross investment from operations, and that would be the one that is not true. Question 25. Which of the following would increase the ROIC of a firm? ROIC is no plat divided by invested capital. So in this case, decrease of equity investments and a decrease in excess cash, as well as an increase in non-operating liabilities. All of those are non-operating items. None of those affect the invested capital of the firm, and none of those would impact the ROIC. So really, this became a true-false question. So back to invested capital. Invested capital is operating assets minus operating liabilities. So in this case, if we increase our operating liabilities, operating assets minus more operating liabilities equals less invested capital. same NOPLAT divided by less invested capital would increase the ROIC of the firm. That would be the correct answer. Question 26. Which of the following would increase the sustainable growth rate, or G, of a firm? Assuming a positive ROIC and a positive G for your answer. So in this case, G equals investment rate times ROIC. So if we increase the payout rate, we decrease the investment rate. Well, that's not going to increase the growth rate, very similar to the other question. Second, an increase in the ROIC of the firm. Well, if we have the same investment rate times a higher ROIC, we get more sustainable growth. That one is the correct answer. By the way, if a company changes its free cash flow, we don't know whether or not that cash flow was a good or bad ROIC, and we don't really know whether or not that money was being reinvested or paid out. So in this case, we don't really know the actual amount of change in reinvestment that was going on there. So essentially, there's just not enough information from the increase in free cash flow to answer the question. So correct answer, an increase in ROIC of the firm. Question 27. What would explain the difference in EBIT multiples for the following two profitable peer companies in the same industry with the same expected EBIT? And in this case, same expected NOPLAT because they have the same tax rate. If you remember in the key value drivers equation, when we derived it using Excel and we went through the company A, B example, we talked about there were three drivers that would primarily explain multiples. They were growth, they were ROIC, they were WACC. So growth and spread, we said, were the primary drivers of multiples. So in this case, it just said these three things would be the primary drivers of the multiples. And so therefore, the correct answer would be all of the above. Question 28. The final three will be sort of essay questions that I'll need to grade. So in the auto scoring part of the exam for ELMS Canvas, ELMS should have scored the exam for you and shown you the correct answers, with the exception of the final, final 7 points. So basically, here's what I'm going to be looking for when I grade the essay questions. In terms of explaining the role of expectations in stock prices, we had talked about how companies are based on their future cash flows. So the key to expectations is that the expectations are the expectations of the future cash flows that will be used to value the company. And so ultimately, expectations play a primary role in the valuation of companies. That's really core to what I am going to be looking for in the answers. And then in addition, it would be nice if you said something like, as expectations change, it will change the expected cash flows of the firm, and therefore it will change the ultimate value of the firm. And that's actually one of the reasons why I chose Coke as a company to value today, given that their growth is starting to disappoint investors and it is changing their prospects for valuation in the future. Question 29. CFI analysis. What's going to be important when I grade the CFI analysis is that you talk about all 4 sections and you refer to specific data points. Now, I'd given you 5 years worth of data, so I said you must talk about the 4 areas and you got to refer to the data points in the specific answer to the question. So that's specifically what I'm going to be looking for. So in this case, we want to make sure we talk, the first section is free cash flow. Company had a positive free cash flow of $3.3 billion. That was 32% of its gross cash flow. So essentially, on an implied reinvestment rate, that would be a 68% implied reinvestment rate in its operations. So in this case, where is it reinvesting? About 19% is going into working capital, about 45% into CapEx, about 4% into intangibles and acquisitions. Although most of the intangible and acquisition was in the first 2 years, seemed to have a write-off in 2012. For capital expenditures, their capital expenditures were stronger in the first 2 years and then tended to get to a lower level in the final 2 years, peaking at $1.661 billion in 2009, falling to $593 million by 2012. Although this company had pretty stable growth in its gross cash flow through 2011, and then a big drop off in 2012 in its gross cash flow, which it mitigated by essentially disinvesting in the firm. So as the gross cash flow went down, they freed up a bunch of working capital that gave them negative investment, and they apparently sold or wrote off an investment, which gave them some cash back through goodwill, giving them $3 billion worth of cash flow. On the non-operating side, this company then generated 5.7925 billion of CFI. And so to get from about 3.3 billion of free cash flow to about 5.8 billion of CFI, this company generated about 2.5 billion of non-operating cash flow, primarily by decreasing their excess cash balance. A lot of that was done in the first year, 2008. In terms of the financing side of the balance sheet, what did they do with the $5.8 billion? Well, this company spent $255 million on interest. This company increased its debt by about $1.6 billion. It also used some of the funds to buy additional minority stakes in other companies, particularly a $1.25 billion purchase in the final year, 2012. The company also paid $1.1 billion worth of dividends, and the primary use of the CFI was $4.257 billion that was used to repurchase common stock. So something along those lines is what I was going to be looking for in your answer to CFI. Final question was the ROIC tree. Evaluate the ROIC tree using the attached file. What's going to be most important about the ROIC tree is you cover both levels of analysis. So level one, you had to talk about the tax rate, the operating margin, and the productivity. So in this case, the end of year ROIC for this company went from 38.2% to almost 43% in 2012, an increase of 12.3%. Tax rate went from 27.8 to 19.4, which was reducing the tax rate by 30%. That should have helped the ROIC. So in this case, the pre-tax ROIC went from 52.9 to 53.2, a 0.6% change. So what we can really conclude is this company's almost total improvement in after-tax ROIC came from lower taxes. It didn't really come from a change in its operating performance. Now, relative to the 0.6% change in pre-tax ROIC, the operating margins of this company did fall by 16%. It went from 30.4% in 2008 to 25.4% in 2012. And that was offset by the gains in productivity. So they had a 16.4% drop in operating margin and a 17% gain in productivity. They went from spending 57.5 cents per dollar of revenue on invested capital to 47.8 cents per dollar of invested capital on per dollar of revenue. And so that gain in productivity offset the drop in margin so that they can maintain their pre-tax ROIC. And again, it was the after-tax ROIC that improved because they paid less taxes in 2012. So second level of analysis, why did the operating margin fall? Well, their gross margin went from 67.3 to 64.8, so they lost pricing power. Their SG&As went from 30 to 33.4, so they spent money while their gross margins were declining to probably try and grow sales that didn't grow. And depreciation, at least it grew at the same rate they expected. Their depreciation expense went from 6.9 to 5.9, a drop which would have benefited them, but what really hurt them was the drop in gross margin and the big rise in SG&A. In terms of working capital, why did they improve their working capital? Invested capital. They improved their working capital from spending 11 cents in 2008 to spending about 3 cents in 2012, a 72% drop in working capital. PP&E went from 24 cents to 23.6%, a little bit of a drop in PP&E of a little under 2%. And intangibles went from 22 to 21, again, a drop of 5.4. But if we want to look at the primary reason for the improvement in productivity, it was working capital. So basically, the decline in operating margin was driven by the drop in gross margin, the spending in SG&A that came at a much higher rate while their gross margin was declining, and it was offset by an improvement in productivity, which was primarily driven by working capital productivity. that, again, would have been all I was looking for in an ideal answer, covering those sections. Okay, so that would have been the midterm exam. As I said, what I really want to spend our time today on is Coke and Coke stock. So with that in mind, we go back to Coca-Cola. And I'm going to start with the Starbucks model. And I'm going to start with the as-is model, which I had mentioned to you beginning of this webinar. And we're going to repurpose the Starbucks model for Coca-Cola. So I'm going to save this in my Coke folder. And I'm going to save this as KO. And then I'm going to call this the baseline. Now, baseline doesn't have any meaning in the real world. It only has meaning in our class. And what the baseline is going to stand for is basically setting up our model by just putting in all the raw data that we're importing from Bloomberg. It's not going to give us any meaningful stock price. It's just saying that our model is at that point ready to do an as-is valuation of the company. So here's what we're going to do with our now baseline version of the Coke model. Remember that the model works from left to right, the first three tabs. The data IS, data BS, and data CF, income statement, cash flow, and balance sheet are the historical data coming from Bloomberg with right now Starbucks in it. So what I want to do is I want to overwrite that with the Coke data. So again, going to my downloads folder, I'm going to take first the income statement data for Coke. I'm going to select it, copy it, come in here, pay special values. Oh, sorry, wrong tab. Don't paste it there. Paste it into the income statement tab. Make sure I paste it in the right tab. Pay special values into the income statement tab. Okay, so I basically just overwrote, and again, line by line, using the Bloomberg standard data into the income statement tab. Make sure you put in the income statement tab. Don't do what I did, accidentally put it in the wrong tab. Second, balance sheet. So again, I'll go back to the top. This is the Starbucks data and the balance sheet using the Bloomberg standardized format. So again, KO balance sheet, select the balance sheet, copy it, paste special values, and I've overwritten the balance sheet data. And I'm finally going to do the cash flow data. So go to KOCF, select all the cash flow data, copy it, overwrite what was the Starbucks cash flow data, paste special values. Now you might say, why don't I just copy and paste? Why am I taking the extra step of doing paste special values? And there is a reason for that. And the primary reason that we're doing that is that when we copy paste between spreadsheets in Excel, Microsoft can sometimes make a link to that external spreadsheet so that every time we open this spreadsheet, it'll look for the spreadsheet that we had imported the data from. And that will cause us problems in the future. So if you copy paste special values, it doesn't copy any of the links, it just copies the numbers. And that's why it is just safe to use that extra step of copy paste special values so that we don't cause any problems for us later, particularly when we're going to use this model again and again and again. So we now have the income statement data, we now have the balance sheet data, we now have cash flow data from Coca-Cola. Now, one could have also said, gee, Joe, couldn't I have just put the Bloomberg data in there without converting the Bloomberg data into values and just using the Bloomberg lookup fields that Bloomberg originally exported from Bloomberg? and then just have the model auto update every time I open the Excel file? And the answer is yes, we could have, but the one challenge with that is that you would have to have a Bloomberg terminal on your laptop every time you open the model. Otherwise, the model would give you errors because it tried to get to the Bloomberg database, it wouldn't find it, and then you wouldn't be able to use your Excel spreadsheet. So that's why in the video on exporting data from Bloomberg, we will have to convert the exported data into numbers, copy paste special values, and that's why we're individually importing the process into the spreadsheet. It's an extra step, ends up taking us an extra 10 minutes versus having an automated model, but it is a relatively efficient process in terms of reusing the model outside the Bloomberg lab when you don't actually have access to a Bloomberg terminal. So we have now put in the historical financial data. We're ready to continue updating our model. The next update we're going to need to do is on the assumptions tab. And we need to start changing all of the assumptions. So first, if we look at our balance sheet, we can check the last reported year. And Coke just this week reported their 2013 numbers. So that is the last reported year, 2013. So I don't need to change that. We're still going to leave operating cash at 2% of sales. That's just a standardized assumption we're going to use this semester. 2% of revenue is, again, 1 week of cash. We could choose to raise this number. I wouldn't recommend lowering that number for any firm, but basically we could raise it. That will actually mean more investment in the firm over time, but I think 2% is reasonable unless we really know what the level of operating cash is. For cost of capital, I'm going to go back to our DES screen. So we took the DES screenshot of Coca-Cola and, cost of capital, the WACC screenshot, WACC. And on the WACC screenshot, we're going to use the WACC as our cost of capital. So in this case, 7.8%. Continuing value, NOPLAT, ROICG, and price to book multiple and continuing value economic profit are being calculated by the model. So in this case, it's the last 11th year, the T+1 year in the continuing value equations. So right now, we're just going to use those in those fields, and we're not going to change those. Next one is shares outstanding, 755.9. So that's what we need the DES screen for. Let's go back to DES. And I need to put in the shares outstanding for Coke, which obviously a lot higher than what they were for Starbucks. 4,402,000,000. So 4402 shares of stock. All right. Next, I need to put in the consensus data for sales and operating profits for the next 2 years. Obviously, Coke is bigger than Starbucks, so I'm going to get that consensus data from the EEO screen. So sales of Coke in 2014, which is forward year 1, 47,470. So make that 47,470 and 49,561. So 49,561 billion. And operating profits, 11,345. And 12,097. Now it's interesting to see that at the time of this recording, see all those red lines? Those are drops in estimates by the analysts that occurred recently. And this is what I mentioned about their sort of very disappointing earnings call. When Coke released their earnings, basically they said they weren't getting the growth that they expected. The analysts were really surprised by this, and they've gone in and they've adjusted the model for Coke that they had on a cash flow basis and adjusted their consensus estimates down. And that's where you can see all of these red lines, which are happening in the next 3 years. That profits are now lower than what was previously expected, and essentially they're just going to have lower margins all across the board. Right? So that has been some of the disappointment of Coke, and some of the price to earnings that has been lower, which now means a lower share price since the earnings announcement. All right, so back to Coke. We also need to make sure that we update these three fields: goodwill, pension obligations, and operating leases. As I'd previously mentioned, in the balance sheet, Bloomberg, I'll shrink this a little bit so it's easier to see. Bloomberg gives us a standardized balance sheet going to total liabilities and equity. So somebody has taken the 10K, they have mapped the 10K to the standardized format, and they have put this standardized format into their database of the data. But here's the thing. There are footnote data, and the footnote data is not standardized company by company, and Bloomberg puts the footnote data into something called the reference items section. What's important about the reference item section is, unlike the balance sheet standardized data, the reference items are not standardized company by company, and they don't always occur in the same row based on where the analyst puts them in, because they're not company by company. Some companies have fewer of them, therefore it shows up in different rows. So there are three pieces of data we need essentially from the footnotes section in the reference items of Bloomberg in the model that aren't always in the same place. So our model doesn't work as a repeatable model unless things are in the same place. So what we've done is I put in the bottom of the assumptions the three items that I need to be in the same place. So the model is actually referring to these in other tabs, and in order for them to be updated, I have to manually update them from the balance sheet. So the first is goodwill. So what I'm going to do is for goodwill, which is in this model on row 67, and in the assumptions tab, I've mapped it so it goes from left to right, current year on the left, previous year on the right. So copy the historical goodwill data for Coke. Actually, make sure I should paste that by doing that. Try this again. Copy. And come over here to assumptions and paste special values. And same thing for pension obligations. Copy. Try this again. Copy. Paste special values. And finally, I want to go back to operating leases. And if I look at Coke, their operating lease obligation is currently at 0. Now, this actually presents us a little bit of a problem with the valuation of Coke. And the reason I say that is because Coke just reported their data this week, which means Bloomberg is actually taking the data from their press releases. They're not taking it from their 10K because the 10K has not yet been filed. So if we go to the end of your database, we're not going to see the 10K. So here's what that means. There's missing data that Bloomberg doesn't have access to at this time. And you can kind of see that because here in the top of the screen, it says preliminary as opposed to original. When it says original, it means that's what they got from the 10K. Preliminary means those are the numbers that the company reported via press release or put on their website, but the company didn't yet file it with the SEC, and the data hasn't come from the SEC. So Bloomberg has put in the preliminary data. If there's any changes that come with the SEC filing, and usually there's not, but there could be, or if there's missing information, you can't put in the missing information. And that's going to be a little bit of an issue for us because historically, Coke had goodwill, and we can't have our goodwill go down to 0. Historically, pension obligations, sorry, that's what I meant to say. had pension, they've had leases. We can't have it go down to zero when it's probably not going to be zero when they release their 10K, but it's zero in the Bloomberg database because Bloomberg doesn't know what it is. So a little bit of a conundrum. What do we do? Well, in a sense, we're going to have to guesstimate what this number is for Coke as a placeholder, knowing it's not perfect, but at least we need to be reasonably close to what we think the number is so that we can do an adequate valuation of the company. So in this case, if I look at their historical pension obligations, at least for the last couple of years, I've seen they've gone up a little bit, about $100 million between the last 2 years. And what I'm going to do is say that since, go back to the income statement, since Coke's revenue really didn't change that much between 2012 and 2013, actually went down from 48 billion to about 47 billion. I'm going to say that I don't think that pension obligation has changed that much. And the same thing with the operating leases. So as a placeholder that I would want to change later, but at least need something now, I'm going to make the 2013 pension obligations the same as the 2012 pension obligations. And the operating leases, which again are zero, I'm going to make again about 931 million just so that I have a placeholder in there, right? So again, I need to have some valuation numbers for those. I can't just have them go from 3 billion to zero, knowing that they're going to be some number going forward. So I'm having to make a guesstimate, and that's what I'm going to do as my initial guesstimate. All right, now continuing on, ratios. I now have to put in my ratios for 2014, 2015, based on the earnings estimates as the process that we had set up in the class. Now, here's the thing. Carrying over in the Starbucks model, using the earnings estimates that we just put in, sales for 14 and 15 have already been put in based on the consensus estimates, and those are the requisite percent changes. Okay? So here's what I'm going to need to do. I'm going to need to take the out years and forecast those. Now, these were the percentage growth rates of Starbucks, not Coke. And we can see that Coke is not expected to grow close to 10%. As a matter of fact, every year it's had relatively lower growth with the exception of 2010 and 11. 2011 was due to an acquisition when they bought their bottlers. So essentially, Coke, the company, now they bought their bottlers, is actually a relatively mature company. Their organic growth is not that high. And that's what the analysts are expecting. So for now, as I build what I call my baseline, I'm going to just equal, starting in 2016, the 2015 number, because these are the 2 first years of consensus. And then I'm going to copy and paste this forward because I want to undo any changes that I have made into Starbucks. One of the reasons I'm going to get crazy valuations when I reuse my model sometimes is that I'll make, in these yellow fields in the out years, hard-coded changes to a company. When I reuse that model for another company, those hard-coded changes are still there. So if I reuse the model, I have to undo the hard-coded changes. That's what I'm calling the baselining process. Right? Again, it's just meaning for our class, which it just says set the model up so that we can make reasonable assumptions and the assumptions aren't carrying over from previous companies. Another example would have been in cost of revenue. So in this case, equals previous year, copy and paste that forward. And the other assumption I remember that we made was down here with tax rate. Now, with, if you remember, Starbucks, we had taken a 5-year average tax rate and now the 6-year average tax rate, because we said for Starbucks, 2013 was an outlier year. Well, for Coke, it doesn't appear that they have any truly outlier years, with maybe the exception of 2010. But in this case, what I'm going to do is an average tax rate for the previous 6 years. So I need an expected tax rate on a go forward basis. And I'm going to say that I think 22.3, which is the average of the 6 years, as I look at the other years, does not look to me to be unreasonable. Coke is a global company. They're not US. So they're obviously taking advantage of the fact that they're getting international operations to lower their effective tax rate. and I think that that's probably going to continue. So I think that that's very reasonable. And then again, for 2015 forward, we had already equaled 2014. Right? And the final number I have to look at is non-operating gains and losses. Again, I'm looking at any outliers here. And the reason I'm jumping to this is that 2010 appears to be an outlier number. And I don't think 5.4% is realistic for them on an ongoing basis. So I think somewhere probably in the 3% range. So I'm going to put that at negative 3% by eyeballing it is probably a more reasonable number looking at the other 6 years, 5 of the 6 years, taking out the 18.6. Right? So this gets me to a almost baseline stock price of $45 a share, but I haven't put in the margin assumptions for the next 2 years. So this is where I'm going to go back to my earnings estimates. So based on the consensus estimates, the consensus operating margin is actually better than the model operating margin. So even though we saw the red lines in the earnings estimate screen for Coke come down, which is another way of saying that the margins are expected to improve, but what they disappointed with is they're not going to probably improve as much as Wall Street was hoping for. So I still need to put the relative improvement into my model to come up with a more realistic share price. So in this case, my model currently has an operating margin of 21.83% on the ratio screen. And I need to match the consensus estimate, which is the operating profit divided by the sales that I just saw. So I need to reduce my cost of revenue by 2%. So in this case, cost of revenue minus 0.0207. And in the next year, they're going to gain another 0.5% of margin. So ratios minus 0.0051. Assumptions. This is now a zero difference between the 2 years. All right, so I'm going to save this file as what I call my baseline valuation. So this value that I came up with is, as I said, it's not a completely meaningful number because I haven't forecasted the out years, but I'm now ready to start forecasting the out years to do my first of two valuations. So the first valuation I need to do is my as is. So again, the key to the as is valuation is I want to replicate the current stock price of the company that I'm valuing. And again, my rule of thumb is within $1, relatively close to the existing stock price. So right now, and I can actually see the stock price on the DES screen. So I go to my DES screenshot. I can see Coke is trading at around $38 a share. So I'm at 51. So in the as is, the market doesn't expect Coke to grow or get the margins that they're currently doing in the future because they're trading at 37 and I have them at a stock price of 51. So I'm going to have to make some changes or adjustments to get to a lower share price. All right. Now, this is where it might be helpful to go to IBISWorld. So I'm going to see if I can get to IBIS, and I just don't know. Okay. So click on Finance, IBISWorld. And in IBISWorld, I'm going to do a search for Coca Cola. And for the industry reports, try soft drink. And one thing I'm going to look at is key statistics. I want to see what they're projecting for growth rates for revenue going forward at an industry level. And what I can see is for 2014 through 2018, very flat revenue growth for the industry, particularly now this is US, it's not worldwide, but it probably infers a good chunk of business at Coke is in the US. So essentially, what I'm going to see is that I think that this is the end of growth for Coke that the market is starting to worry about. It's probably starting to show up in their stock price. So that's what I'm going to use to help me infer what I'm going to do with my revenue forecast. Now, for the next 2 years, I'm not going to change the revenue forecast from the consensus estimates. I'm only going to do the out years. But here's the thing. What if I end up growing at 2% or 1% or 1.5% on a go forward basis? And particularly by, if I go back to IBIS, 2017 is a little bit of a recession year that they're predicting, and then low single digits. So what I'm going to do is say that Coke is growing a little bit faster than the rest of the world, mainly because they have some competitive advantage. But by 2017, maybe they don't get any growth. And then 2018, maybe they start growing again at about 1%. It's kind of reflecting the same recession year that they're forecasting, and then 1% thereafter. Now, here's the other thing that we hadn't done previously, but I'm going to go back to my assumptions and I'm going to look at my continuing value G. For Starbucks, we had a 4% G, and in this case, for Coke, I think 2 to 3% is probably more realistic, especially if they're not growing. So what if we change our G to 2%, and then I'm at a $32 share price? So what I'm going to do is, instead of 1% growth, let's put 2% growth. Instead of 1.5, what if I put 3 and made that, actually let's make it 2 and 3. Okay. And here's the thing. I'm getting relatively close to their share price. So what I'm next going to do is I'm going to say, if I look at their operating margin, which was as high as 26%, it's expected to get 24, but it was low as 22 the last couple of years. I think as the growth slows, it's going to put up a little pressure on their operating margin. So instead of 32.5 by 2017, I'm going to put it at 32, so that their operating margin falls here. This was 22, and it falls back to 25, which is still better than what they've done historically. I'm at 37.29, and by the way, I was trying to get to 37.47. So I think I have a reasonable story of what I think is the as-is valuation of Coke. So if I take a step back, and I'm going to save this, as my as-is file. I've now completed what I would call the as-is valuation. And now I have to explain my assumptions. So essentially, I've put in some assumptions to get to the current share price, and I need to explain what changes I made and why I made them. So again, step back. The changes I made is I said, look, given that the industry, particularly in the US, now Coke is international, which means it's probably going to grow a little faster, but the industry in the US is expected to be very flat. I think that they're not going to experience a lot of organic growth. And I do think Coke is going to grow a little faster than the rest of the world or the rest of the market, just because they do have a great brand and they are in the rest of the world, which is probably growing a little faster than the US. So we give them low to mid single digit growth below 5%, so in the 3 to 4% range going forward, predicting a little bit of recessionary year in 2017, just as the IBISWorld report did. And we also think that the tax rate is reasonable going forward. And finally, I think that the operating margins, which are improved, they will probably be better than they are in the last 2 years, but I don't think that they're going to get much better than they are in the next 2 years. It might see a slight drop in operating margin from about, and again, we're focusing on this line here when I say operating margin, from about 24%, improvement, drop in the cost is what I should say, to slight more improvement to about a 25% operating margin, which is better than what it's been the last couple of years, but hasn't been what it was historically. Now, part of the reason why I can infer that Coke might be able to continue to improve its operating margin is the fact that they just announced $1 billion worth of cost cuts. So at this point, I think what Coke is starting to transition to is very large dividend, stock repurchase. They are cost cutting, and I think that they're preparing themselves to be a slower growth firm and to start optimizing that cash flow. They talked about that in their recent earnings call, and if I infer the future, I think that Coke will be even more aggressive at cutting costs out of their relatively large operations as they transition from a growth company to a company that is a more mature company. And as a result, I think that they're going to focus on maintaining that margin, given that that growth rate is relatively low. I think they have competitive advantage to maintain the margin. I don't think in a lower market that they're going to get to the margins they had in 08, 09, but at the same time, they might be able to continue to optimize and get some cost cuts. And so I think that might be what the market is thinking when they're pricing them today. So I think the disappointment of the market was that the growth wasn't going to be higher, and that the margins weren't going to be even higher. But I think that by Coke simultaneously disappointing on the growth, but saying, look, we're going to get $1 billion worth of costs out, they're still showing they're getting improved margins. They're sending a message they want to protect those margins on a go forward basis. And I think that's what the analysts are picking up on in their models, which is why Coke stock did not fall off a cliff when they disappointed the market. And there is some still improvement in the margins on a go forward basis, assuming they continue to focus on cost reduction. Hence, as is stock price 37.29. So again, I need to give the assumptions that I believe for the company that are realistic, and essentially my point of view on why I think those assumptions might be playing out in the market. Matter of fact, I could do this as a range because I could show slightly higher growth and lower margins. I could show slightly lower growth and higher margins. But I think somewhere in a band of plus or minus 1% of that growth rate and plus or minus 50 basis points to that margin, I think is realistically what the market is thinking today when they're pricing Coke at around $37 a share. So that is my as is valuation of Coke. And now I have to save this. Again, I'll save what I've done. And I'm now going to save the file and rename the save file, save as, my final valuation. So remember, we're always doing two valuations of a company. One is we know the share price of the stock today. What assumptions lead us to the stock today? That's the as is valuation. Then what we're going to call the final valuation. What is my point of view on Coca-Cola? Do I believe the assumptions that were put in to get to the as is valuation? So do I think it's a good time to buy Coke, or do I think it's a good time to sell or hold? Now remember, the bands that we're using is plus or minus 10%. So if I change my assumptions and I'm within plus or minus 10% of the current share price, I'm going to call that a trading range, and I'm going to call that a hold. If I change my assumptions and I'm more than 10%, I'm going to call that a buy. And if I am 10% below, I'm going to call that a sell. Okay? So that's the way I'm going to think about my buy, sell, hold opportunities. So back to Coke. What do I think about these assumptions? Well, again, the first 2 years, really not going to change because I think that Wall Street's consensus is probably pretty good about Coke. And the company's guidance has probably put the analysts into a range that is reasonable. So I don't think that they're going to be that far out of the range in the first 2 years. It's really the forward years that are going to matter. So what is my view on Coca-Cola? Well, one is I could take a pessimistic view and I could say, you know what? I think Coke's growth rate given the IBIS report, is going to be lower. And I think part of the reason for the low growth is that sugar is increasingly being looked at like nicotine in a very negative light. I think people are starting to adapt their diets. I think governments, including particularly the more aggressive US government, is starting to make sugar more unattractive through tax and other health issues. And I think it's causing a transition away from the traditional cola drinks. And I think that's hurting Coke, particularly as people drink water, which is much better for you. So, long story short, I think that will challenge their growth. And if Coke's growth is challenged and they get anywhere near the long-term point of view, and I'll go back to my assumptions, so that my continuing value growth is more like 1.5% or 2%, then they're a clear sell. So now might the time to be getting out of Coca-Cola stock because they have peaked and they are going to be on sort of a slow, steady decline. And sure, they'll give lots of cash redistribution to the investors, but on a value basis, I don't see a lot of value there. So I give them a sell recommendation. So I could save this as final sell. So that could be one scenario that I've explained with my point of view and I've explained how I got to my assumptions. Or I could say, go back to the original final valuation that I just saved. So this is back to where I started with my as is. I can say, you know what? I think the market is misunderstanding Coke. I think that Coke is going to continue to diversify away from their cola products, which even though sugar is negative, they're getting into other market opportunities. They're getting into healthier drinks. They've shown that they're willing to acquire. They're shown they're willing to innovate. They have products like Dasani water, and they are a beverage company. And beverages, particularly beverages that you pay for, are going to continue to grow, particularly outside the US, because water is going to be a problem for a lot of countries, and Coke is going to sell drinks, and that is an alternative to water. And particularly as people get wealthier, they're going to look for those drinks, and Coke is going to be there to provide them at a reasonable price. So I actually think there's a more bullish scenario. And I do think that Coke has some growth in them. Now, again, law of large numbers, I don't think it's 10% growth, but I think the market's got it wrong. And I do think that they can grow at 3 to 4% on a sustained basis. So I'm going to put this at, starting in 2016, 4%. And I think that even though IBIS says the US is more challenged, I think that internationally they still have maybe 3.5%. They still have some ability to grow internationally, and that Coke as a company with competitive advantage will do that. So at that growth rate, I think they're worth closer to $44 a share. And I think that this dip might be a buying opportunity for Coke, that you buy them on the dip. This is a company that's shown they're willing to aggressively cut costs when necessary, but at the same time, they have historically made acquisitions to get them positioned better. And these acquisitions have not yet paid off. And it's putting them in a position where they will do well, particularly in international markets. And I think we're underestimating how much growth they're going to get in international markets as people become wealthier and they put more of their disposable income. So I say buy. So again, I say target price 44, 43, 46, current share price 37 something, more than 10%. That's a buy. And I will put a buy on Coke. So now I just have to decide which of those two stories I like better. And to be honest with you, I like the buy. I am a little bit more optimistic on Coke. So if I had to choose between buying and selling Coke, I think at this point in time, I think that Coke might be a good opportunity to buy in this dip and that there is some upside in their share price. And I don't see a lot of downside risk because they do have extremely strong cash flow. They're willing to redistribute it in the form of dividends. As a matter of fact, we could probably see that on the CFI. If we look at share repurchase, they've been strongly repurchasing $4.5 to $5 billion a share. They've been paying almost $5 billion of dividends. they're redistributing all of their free cash flow to basically share repurchase and dividends. And essentially, it does give them flexibility to do strategic acquisitions, change that stock repurchase if they ever needed to. But I think it goes back to their competitive advantage. They're really good at what they do, and I think they are positioned in markets that have some growth potential going forward. So I am more on the buy side of Coke, and I think that that is going to be the choice I'll make for my final recommendation. So, in a sense, that's what you're going to need to do on your next homework for assignment. So, the company that I want to give to you to value is going to be Target. Uh, Basically, the reason for that is because of this scandal with the credit card scandal. There's some concern about whether or not that will truly impact Target in the long run, and whether or not Target is in trouble, or whether or not Target is going to recover from this and they might actually have a buying opportunity. So what I want you to do is I'm going to ask you to, using the Bloomberg Lab and using the Bloomberg data, and using the two videos, the one from this webinar and the one previously posted, which shows how to get the data from Coca-Cola, and the process for using either the Coke model and or the process for using the Starbucks model. You can start with either one to basically get the data for Target in the next couple of days. It'll be due before Monday's class, and we will discuss this in class on Monday, to basically do an as is and a final. You'll have to put both spreadsheets into your assignment for homework 4, and you'll have to do a write-up on the assumptions. And what I'm really looking for is a couple paragraphs just sort of explaining what assumptions you changed and why you changed the assumptions. What was the basis for your point of view in coming up with the as-is assumptions and coming up with a buy, sell, hold recommendation. Now, I did both a buy and a sell for Coke. You don't have to do that. I just want one. So I either want buy, sell, or hold. So what is your as is? What is your final? What is your rationale for each? That is your homework for assignment. So I'll pause here to see if there are any questions. All right, so I'm going to end this webinar, and I'm going to post this as a YouTube video, and I'm going to give you the remainder of class time to go to the lab and to start the process for doing your homework assignment. If you have any questions about doing this, remember you also have the opportunity to take advantage of my undergraduate TAs who have office hours this afternoon and who have office hours tomorrow night to help you live, or you can send me emails. I'll post homework 4 in just a few minutes, but per the video, the company in question is Target, ticker symbol TGT. And again, you're doing an as-is final, so you'll upload 2 Excel files, and you'll give me a write-up, preferably in a Word document. So 3 total files for your homework assignment, and that is what we're looking for. All right? If you have any questions, please feel free, like I said, email me. You're welcome to check out with the TAs. And otherwise, we'll see everybody at our next live class, which will be Monday morning at 8:30. Have a great weekend.